A second reason that interest rates move together is because the premium that the market provides to those who lend to riskier borrowers is approximately constant over time. It's not constant, but it's not varying as much as the rates themselves vary. Okay, what's a risk premium? A risk premium is an addition to the rate of interest agreed to by borrowers and lenders that compensates the lender for the increased riskiness of a lending contract. There are several reasons why one lending contract may be riskier than another. We're going to focus on the two most important reasons. So, borrower B may be less likely to repay than borrower A, and I use B and A advisedly. One lending contract also may defer repayment for a longer period of time than another. That is, the contract may have a longer time to maturity. Both those reasons can explain differences in risk, but let's focus on the first one first. Consider first the case where borrower B is less likely to repay a loan in accordance with the terms of the loan agreement, or, if you prefer, the bond. An easy way to check for the existence of a risk premium is to compare the yields on Moody-rated BAA bonds with the yields on Moody-rated AAA bonds, because after all, Moody rates the AAA bonds as more creditworthy because those companies are more likely to repay. So again, let's take a look at some data which shows the difference. Now, I'm not showing separately the BAA and the AAA. I'm subtracting the AAA from the BAA and showing you the difference. What you see is a line that does vary. It has spikes in the 70s and in the 80s, and a huge spike at the time of the Great Contraction. It's reasonable to believe that in those three episodes, particularly, the risk was higher. Especially, it's easy to understand why risk was higher at the time of the Great Contraction. But notice that most of the time, the difference is captured in a fairly narrow band, say between 0.5% and 1 or 1.5%. In short, the risk premium moves a lot less than the various yields themselves. It moves a lot less than either the AAA or the BAA bond yields. On average, between 1971 and 2010, the risk premium associated with holding BAA rather than AAA bonds was 1.11%, with a minimum value of 0.55% and a maximum value of 3.4%. Interestingly, as I saw already, the risk premium was much higher in periods that most economists and financial analysts would describe as periods of high risk. But the onset of the Arab oil boycott, the beginning of the months of Paul Volcker's term as Fed Board chairman, and the opening months of the financial crisis that started roughly in September 2008. Note that while the risk premium rises in periods of high risk, most of the time it's captured in the range between 0.5% and 1.5%. Okay, here's a second reason why risk matters, and a second explanation of why changes in risk move many interest rates together. So let's consider two lending contracts alike in all respects, except that one has a longer maturity. What we need to understand is why longer maturity bonds are riskier. And it's going to be convenient to limit our attention to zero coupon bonds because the formulas are easier to work with. So please recall that the present value formula defines the price of a $1,000 zero coupon bond that matures and zero coupon bond that matures M years from now, M 10, 20, whatever, to be the bond price equal to that $1,000 discounted into the present. And you'll recall that means that we have to divide that $1,000 by 1 plus R, that quantity raised to the M power. In other words, we got to pull those dollars back into the present 1 year at a time for M's successive years. And we remember also that R is defined as the yield to maturity of that bond. In fact, as we learned earlier, we infer the yield of a bond by observing it, the price of the bond, its face value, and its time to maturity. So we generally compute those yields to maturity. What risk does a Treasury bondholder face? It's not the risk that the borrower will fail to repay, since the borrower is the U.S. Treasury. At least we hope that's not a risk. The U.S. government does have the power to tax. That's a guaranteed source of revenue, and it has never resulted in the default of a U.S. Treasury bond issue. So the risk must be of another sort, typically, at least in the data we're looking at. Treasury bond owners face the risk that interest rates will increase after the bond owners have already agreed to lend at a lower interest rate. If interest rates rise, the market value of the bonds that they've already purchased will fall, implying that they experience a capital loss on their investment. The longer the maturity, the greater the fall in that bond price. Let's take a look at a detailed example. You are looking at a table. That table gives you the change in the market price of a $1,000 bond that results from a 1 percentage point increase in the rate of interest when the rate of interest is initially 5%. Now, I manufactured these data, but I manufactured them using our old friend, the present value equation. In the first column, we are going to list several possible yields to maturity, all measured in years. 1 year, 5 years, 10 years, 20 years, and 30 years. Okay? Remember, initially, the price of this bond is just sufficient so that it is equivalent to a rate of return, a yield to maturity of 5%. So with one year, that's $952.38. That 5% interest rate governs that price because $952.38 grows to $1,000 in 1 year when the growth rate is 5%. If the bond is a 5-year bond, we have to start out with a smaller price, $783.53. And if it's a 30-year bond, we have to start out with a very small price, $231.38. Okay? So over 30 years, a bond for which you pay $231.38 and which grows to be $1,000 over 30 years will give you an annual rate of return and annual growth of 5%. But now, I imagine the interest rates after you've purchased the bond, after you've paid that initial price, rise by 1%. Okay? And I calculate the new prices. And they're given in the table. For example, the price of the 1-year bond falls to $943.40. They all fall. So it's bad news for you if you've already purchased. But notice by how much they fall. If you had purchased a 1-year to maturity bond, you would have lost 1%, the last column. If you had purchased a 5-year maturity bond, you would have lost 5%. If you had purchased a 10-year maturity bond, you'd have lost 9%. A 20-year bond, 17%. If you had purchased a 30-year bond and had the misfortune to have interest rates turn against you. Yep. The conclusion? Pretty straightforward. An increase of 1% in the interest rate leads to capital losses which are larger the larger the maturity of the bond. The intuition is straightforward. When interest rates increase, both old bonds that were created earlier and new bonds that are just newly issued must offer the new competitive rate. The only way for an old bond to offer the new and higher rate is for its market price to fall. And the fall, measured as a percent, is larger the larger is the time to maturity. So, why do interest rates move together? Why is it that economists don't feel they're doing anyone a disservice when they talk about the rate of interest? Interest rates move together because they are driven by a common component of all market rates: the price of credit at the time a bond is priced. But because bonds are not identical, their yields are not identical. However, the data strongly suggest that the part of a bond yield that can be interpreted as the risk premium or an inflation premium, those parts vary very little. They vary less than the part of the yield that we think of as the price of credit. Why is this important? Understanding that the price of credit varies with market conditions, and that such variation explains most of the variation we see over time in the thousands of interest rates that one can observe, makes bond markets and credit markets much easier to understand. There's just a substantial intuition for the working of a bond market and the behavior of bond yields. Savers rationally view different bonds as substitutes. Buying any bond allows a saver to move funds from the present into the future. Savers look for those bonds that offer the best combination of high yield and low risk. But because savers are always on the lookout for a better opportunity to store their savings, to make a financial investment, it's simply not surprising that bond yields move together. Bond yields move together for the same reason that prices of different kinds of apples move together. If the price of Golden Delicious apples begins to rise, many consumers will purchase Red Delicious apples instead, with the result that the prices of the two types of apples rise and fall together. Remember, interest rates move together because underlying interest rates is a common component: the price of credit, the price for the right to use funds earlier. Thank you.